braving the cold to come out here. Yeah, it was definitely an interesting drive out. A couple of quick asides. So I was an attendee at some of the earliest of these meetups, and man, has it come a long way. So I guess, you know, big shout out to James and the Mogul team for really building this organization into something pretty impressive. Second, I guess this is totally unrelated to my talk, but an aside here, I thought that people might find interesting. I recently read about a study of real estate affordability in major cities around the entire globe. So it was comparing, like, you know, every city in the world of over 1 million people and affordability of, you know, prices versus incomes. So this would be comparing, you know, Berlin to Johannesburg, South Africa, to cities in Canada. And Toronto and Vancouver were two of the least affordable cities in the entire world. And Edmonton and Calgary were in the top 3 most affordable cities in the entire world. So if you hear people talk about the Canadian real estate market, very different markets. Anyways, that's an aside. Now, I'm here today to talk about RRSPs, TFSAs, and specifically how you can invest using these platforms into, you know, either the real estate market or I guess we could say adjacent to the real estate market. First, quick disclaimer. So this presentation is not meant to be taken as financial advice. Please do your own research. You know, if there's a investment that has an offering memorandum or prospectus, please read that. This is my personal perspectives on selected financial issues, not the views of Westbridge Capital, Mogul Mastermind, Rethink and Diversify Securities, or any other group. This may contain forward-looking statements, and myself and the directors and officers of Westbridge Capital Inc. own units in Westbridge Capital Partners Income Trust, which is mentioned in this presentation. Okay, that's the exciting stuff here. Sorry, I'm trying to, there we go. Okay, so we're going to start off with the basics here, how RRSPs work. So RRSPs are basically a very long-standing method of tax deferral. So when you contribute money into an RRSP, you get to write off what you're putting in, and dollar for dollar, you still pay tax on everything that you put in. You just get to pay it much later. So the idea is that in your working years, your income is higher. Therefore, contributing to an RRSP lowers that taxable income and pushes it into your retirement years when your income is typically much lower. So, you know, this makes a lot of sense for most people, or for, you know, a huge chunk of the population. And it's a really powerful tool, especially if you use it properly. So contributions are limited to 18% of income up to $162,000. You can have an RRSP account managed, like you can go to TD Bank, Royal Bank, have somebody manage your affairs for you there. Typically you get professional advice, but higher fees, or you can go the self-directed route. You don't get advice, you have to do your own research, typically flat fees and a lot more investing options. So most of what I'm going to be talking about is in the second category. Also, RRSPs can be used to balance spousal income. I won't get into the nitty gritty, but you can basically get, you know, the person with a higher income getting a write-off and the tax deferral going into the name of the person with the lower income. Important to note, RRSP accounts can't directly invest in property. So we're going to be talking today about ways to kind of invest either peripherally in property or property related assets, since I know that's obviously an interest of everybody here. I'm not going to dive too much into this math here. Basically, we've got the Canadian and Alberta tax rates there. They're a graduated system and it's a little bit complicated. That's why we have accountants, I guess. I am just going to quickly show you how the basics of an RRSP contribution works with income for a $70,000 income and $150,000 income. So in the first example, you can see taxable income is reduced by the amount of the contribution. Then total tax, average tax rate, marginal tax rate go down by an equivalent amount. The $12,000 contribution, you actually get back a check for $3,843 at tax time. And the $150,000 income, same math applies. There is a greater magnitude of benefit, the higher your income is because of marginal tax rates. So, again, I don't want to bore people too much here by diving into marginal tax rates, but one quick thing that I'll say, and the reason that I chose this 150,000 example is some people, look at RSPs and, next slide, I'll talk about TFSAs, and they wonder how to fit that with their cash flows. So one approach that some people take is to make their RSP contributions from their regular pay. So make it every month because it's very predictable. You know what your income's going to be, what 18% of that is. And then at tax time, take the money you get back and put that in your TFSA. They're both very powerful tools and really hard to beat returns. I mean, in this second example, you're basically getting, an immediate 25% return. It's a little more complicated than that. It's not a return, it's a tax deferral. But if you're deferring tax for decades and then you're paying it back at a lower rate, it's a really powerful tool. Now, if you're real estate minded, this is where we get into the later slides, which I'll talk about here. So next, TFSAs. In a sense, TFSAs work kind of like RSPs, but the opposite. So instead of basically putting in pre-tax dollars, instead of putting in money and then getting to reduce your taxable income by that amount, you use after-tax dollars, and then you never pay tax again into the future. So when you put money into a TFSA, regardless of what income, rental income, interest income, or capital gains is happening in that account, you never have to pay tax. So really powerful tool again. Introduced in 2008. In both cases, contribution room builds. So for some people, like, I learned a little bit late in life about RRSPs. The first time I ever went to open an RRSP, I looked at my notice of assessment from the government. I looked at my total maximum contribution and realized that it had been building up for 7 years or something before I had first opened my account. TFSAs work the same way. So if you've never opened a TFSA, this year you could contribute up to $81,000. By 2023, that would be $87,000. So every year you're getting that contribution room, and use it if you can. Again, these are powerful tools. And if you really like real estate, there are certainly ways that you can accommodate that as well. Like RSPs, TFSAs can't invest directly in property, but there are, again, I'll get to that. So I want to talk a little bit about types of markets. Most of this presentation is kind of, 30,000 foot view stuff. So let's first talk about the public markets. This is kind of what everybody hears about the most, the biggest companies, your New York Stock Exchange, NASDAQ, Toronto Stock Exchange, London Stock Exchange, Nikkei. There's large exchanges all over the world. They're well known. They're traded, they're very liquid. So, money that you put in, you can get in and out of investments very quickly, very cheaply. Individual investments vary widely in terms of returns, risk, and volatility. This is what most people know when they're thinking about markets. It's not really what I'm here to talk about today. Private markets is basically everything else, everything outside of those public markets. Now, personally, I work, most of my job is in private equity. So I find these private markets to be incredibly interesting. Real estate markets are non-public, so this is all part of the private markets as well. Private equity, venture capital, private lending, there's a whole bunch of markets that are tied into this. Typically, there's a barrier to entry for most investors of capital, time, and skill. So if you were to look at, buying a stock in Apple, you could go into TD Bank, get an advisor, say you want to buy Apple. Very easy to do, very liquid. If you wanted to buy, let's say, the dry cleaner down the street, you might be able to work the math out so that that is an extremely attractive deal. But you have to know the dry cleaning business. You have to have the capital to do it, and you have to be willing to potentially hold that for many, many years. So private equity has historically had higher returns than the broader markets. And other private investing, like we're all here to talk about, real estate. If you look at the types of investing that Mogul Mastermind has done since day one, it has largely outperformed stock markets. But you have to, you have to be educated. You have to come to presentations like this. And you have to have limited liquidity. So some people would think of, you know, the limited liquidity as effectively a premium, or liquidity premium is the higher return that you get there. The exempt market is one part of the private market. And what it really means is exempt from filing a prospectus. That's what public companies have to file. So in the exempt market, there are companies that use an offering memorandum, which is very much like a prospectus, and other investments that have gates up. So they only accept accredited investors, which, without getting into the technicalities, are investors that meet certain criteria on income, assets, and some other factors. I'm going to basically skip this section here on opening a self-directed account. It's pretty straightforward, and jump right into mortgage investment corporations. So now I'm not going to talk about, you know, individual companies listed here. What I'm really here to talk about is the asset classes, is, you know, what are the options, how they work in a general sense. I did pick some kind of random funds just to give you a sense that, you know, there is a market, there's a lot of options within that market. And specifically in this case, you know, we've got 3 private companies and 2 public companies. So some of these options work in both public markets and in private markets. So mortgage investment corporations are basically a group of investors pool their money together, and that money gets lent out in mortgages. By law in Canada, it has to be Canadian mortgages. 50% or more must be in residential mortgages. 25% can be in owned real estate, but they can't develop. So for the most part, you know, basically money's being pooled, money's being lent out, and then all the interest that is collected gets paid out to investors. Now, this is where these platforms like RRSPs and TFSAs come into play, because if you own this outside of that, you're earning interest income. Interest income is automatically taxed at the highest rate. If you own it in a TFSA or an RRSP, it's tax deferred or tax exempt in the case of a TFSA. So yeah, again, I'm not going to talk about individual companies here. That's, you know, for you guys to do your own research, and feel free to ask any questions you'd like. But you can see that they, you know, there's significant variance in terms of, you know, what returns people pay. Largely that has to do, is correlated with the risk. So some companies are more first mortgages, some are more second mortgages. There's also construction financing in there. And this is the research to do, is basically what mortgages and what types of mortgages make up a mix that you're interested in investing in. Next, we've got real estate investment trusts, or REITs. So REITs, mix are basically the debt side. You're holding mortgages. REITs are the equity side. So, you know, you're actually owning property through another group. So technically speaking, you're owning shares in a group that owns property, but it does give you pretty direct access to property markets. REITs make equity investments. They can hold mortgages, which means they can benefit from leverage. They must distribute at least 90% of taxable income. So both mix and REITs are effectively vehicles for these companies to, you know, basically bring in money, have it deployed in either mortgages or directly in real estate equity, and then take their rental or interest income and give it back to the group. So fairly straightforward principles. The other thing to consider with REITs is that not only do you have a distribution of rental income, but you also potentially have equity appreciation. So they can also vary significantly. You want to consider that, you know, a REIT that's made up of nothing but property in downtown Toronto is vastly different than a REIT that's made up of properties here in Alberta. You know, markets are different asset classes in real estate are different, carry different risks, etc. And, you know, you want to consider both distributions, like what you're going to make on a month-to-month, year-to-year basis, and what you might expect to make over the long run in property appreciation, because that can vary greatly as well. Also, you can see some of these are traded on the TSX and others are private. I don't actually offer these investments for sale. If anybody is interested in any of these in particular, I can certainly refer you to people who can sell these. Oh, okay, sorry, the text got a little screwed up there. Private mortgages. So this is something that's kind of interesting that a lot of people don't know you can do with an RRSP. You can either issue a mortgage from your RRSP either arm's length to a stranger or non-arm's length to yourself or a family member or other close associate. There's kind of a barrier of scale because it has to be managed by an institution. Those institutions charge upfront fees, setup fees, account fees, etc. So if you were to have a very small RRSP, if you have $10,000 or $20,000, basically ignore this. But at scale, it can be a really interesting thing to do. Mortgages that are issued this way must be insured regardless of the loan to value. So that's one way that this is different than conventional real estate investing. You also can use the higher posted rate rather than a discounted rate that you might try to be getting from a bank. And you can use any rate for an arm's length mortgage. Now, this seems a little odd. You might be wondering, why would I want to pay a higher rate? Well, because you're paying it to yourself. That's the simple answer. So there's a trustee that manages the mortgage and importantly acts in the best interests of the mortgage, not you. So, people start to hear about this, and one thing that quickly pops into their mind is, well, I've got a couple $100,000 in a RRSP. Why don't I buy a house, give myself a mortgage, then default on the mortgage, and I get to keep the money and the RRSP gets cleaned out? Well, the reason you can't do that is because you have a trustee involved and they're not looking after you, they're looking after the mortgage. So they would foreclose, etc. Your cash balance is going to increase over time as you pay your mortgage because, again, you're paying it to yourself in the form of an RRSP account. This usually makes the most sense for investment properties, as you'll see in the quick examples here. This arm's length mortgages are offered by a bunch of different services: Olympia Trust, TD Waterhouse, Canadian Western Trust, B2B Bank. Non-arm's length is pretty rare. It's the only company I know of that offers it is Canadian Western Trust. So first example, non-arm's length mortgage, primary residence loan that is initiated out of an RRSP on your own home. So $200,000 loan on a $250,000 purchase, 5-year term, 25-year AM. At the 5.9% posted rate is a $1,267 payment, not tax deductible. Second example is an arm's length mortgage made to a stranger. So you could either go to a broker, you could go to one of the services that manage these mortgages and have them put you in touch with somebody looking to borrow money. And then you can negotiate whatever rate you want. And typically these are high rates. So, in this case, it's the second mortgage. This hypothetical rate we've got here is 11%, much higher payment. You can look at pretty enticing interest coming into your account for many years. Third example here, personal investment property, non-arm's length. So this is basically you're buying your own investment property, same numbers as the first example, the difference being that it's not a primary residence, it's an investment property. So in this case, same rate, same terms, but the payment is tax deductible. So like I was saying before, why would you want to pay a higher rate? Well, if you're paying it to yourself, you have a tax deductible payment, means you get to lower your personal taxes while building money in a tax deferred way for decades before you're going to owe tax on it, or potentially decades. Private debt funds, this is the last category I'm going to talk about, not directly related to real estate, although they can hold real estate. So private debt funds issue loans to private companies. They're typically more flexible than banks, and they're used to fund acquisitions, growth, working capital, infrastructure, and or real estate, or any combination of the above. So these can be based on asset value or cash flow value. In real estate, you're probably used to hearing terms like loan to value ratio. In a private debt fund, it would be much more common to hear about the debt service coverage ratio. So both are measures of kind of breathing room, financial health and stability. One is based on the asset value, one is based on the cash flow value. It's a popular asset class amongst pension funds, institutional investors, and growing in the mainstream. I'll also maybe just quickly note the first one there is our fund. This is actually the only thing in the presentation that I do offer for sale. Not directly soliciting anybody. Happy to talk about it later. We've got a great track record. Some things to look out for in all investing, like if you want to look at any of these asset classes. Reputation, historical returns over the long run can be a great indication of future performance. Having that stable track record, having detailed, hard financial data rather than fluff. Any company that wants to promote themselves is going to be putting out information that's going to be very complementary to them. But if people are putting out, hard financial ratios and, hard data in the form of financial statements, that's a lot more meaningful than, a lot of fluff out there. Just as a quick note, there are 3 types of financial statements, what's called a notice to reader statement, a review engagement statement, and an audited statement. A lot of people don't really know the difference, but there is a vast difference between these. I keep hearing in the news about these, giant scams, FTX and, Bernie Madoff. So Bernie Madoff was getting audits done by an accountant that was located in a strip mall with a multi-billion-dollar fund. FTX, I think, was, similarly, I'm not even sure if they were getting an audit, but it certainly wasn't by a reputable firm. And that actually, it means a lot. So if you look at a firm that has, let's say an audit from KPMG or Deloitte, a big 4 firm, you can trust that information that you're seeing. If you see a firm that has a notice to reader statement from an accounting firm you've never heard of, you can't necessarily trust that information. That's all I'll say. It's important to consider diversification. Simple diversification is just, holding multiple investments instead of a single one, but also geographical diversification. If you were to hold 10 MICs and every one of those MICs is full of property that's all in Vancouver, you're really not actually diversified. The same market forces that, affect one of those MICs will affect all of them. And industry diversification, especially as you step out of just real estate, like the private debt I was mentioning. As well, correlation. So a lot of people in the financial industry look at the correlation of different markets. So, if you were to compare the TSX, the NASDAQ, and the New York Stock Exchange, over time, they tend to go up together and they tend to go down together. So if you're diversifying between things that are already correlated with one another, then, they're not likely to move independently. The reason that people get into private markets is because they tend to be either less correlated or non-correlated. You can, I'm sure now we've all seen times when the stock market was having a really bad year and people that held real estate were still collecting their rent every month. And people that held our fund were still collecting their distribution every month. And, people that went and bought that dry cleaner down the street that I was talking about, if the business was still healthy, unrelated to the stock market, you don't necessarily need to worry about the condition of the stock market. So correlation in your own portfolio is something to consider. I think that is about all we've got for slides. So I think, do I still have some time for questions? Good. So any questions? Shoot. So I've actually also never done it. And although I know that there are significant fees and where you can get it done, I don't actually know the answer to that question. I would say call somebody like Olympia Trust. It's going to be like, it'll be in the multiple thousands. So this is why, unless you have an RSP that already has, generally 6 figures and up, that's the point at which you can start to look at something like that. Sorry, I couldn't give you a better answer. Any other questions?